Imagine a world where inflation spirals out of control, the economy teeters on the edge, and financial chaos threatens the future. Then one man steps in, a towering figure with a radical plan. This is the story of Paul Volcker, the fearless Fed chairman who reshaped America's economy and changed global finance forever. Paul Adolph Volcker Jr. was born on September 5, 1927, in Cape May, New Jersey. He was the only son of Alma Louise and Paul Adolph Volcker Sr., and had four older sisters, Ruth, Louise, Eleanor, and Virginia. His grandparents were German immigrants, instilling in him a strong work ethic and a sense of discipline from an early age. The family later moved to Teaneck, New Jersey, where his father became the township's first municipal manager, serving for 20 years and significantly improving the town's economic stability and government efficiency. This environment undoubtedly influenced young Paul's interest in public service and economics. During his time at Teaneck High School, from which he graduated in 1945, Volcker was an active participant in various student groups and was known for his keen interest in politics. His academic prowess and leadership qualities set the stage for his future endeavors in economics and public policy. After high school, Volcker attended Princeton University, enrolling in the Woodrow Wilson School of Public and International Affairs. He graduated with highest honors in 1949, earning a Bachelor of Arts degree. His senior thesis, titled The Problems of Federal Reserve Policy Since World War II, showcased his early critical thinking about monetary policy. In it, he argued that an excessive money supply posed a significant inflationary threat and emphasized the need for control to prevent sharp price increases. This work foreshadowed his later efforts to combat inflation as chairman of the Federal Reserve. Following his undergraduate studies, Volcker spent a summer as a research assistant at the Federal Reserve Bank of New York, gaining practical experience in economic research. He then pursued a Master of Arts in Political Economy at Harvard University's Graduate School of Arts and Sciences and Graduate School of Public Administration, graduating in 1951. His academic journey continued with a Rotary Foundation Fellowship at the London School of Economics from 1951 to 1952, broadening his international perspective on economic issues. In 1952, Volcker began his professional career as an economist at the Federal Reserve Bank of New York. He left in 1957 to join Chase Manhattan Bank as a financial economist, where he deepened his understanding of banking and finance. His career took a significant turn in 1962 when he joined the U.S. Department of the Treasury as Director of Financial Analysis. By 1963, he was appointed Deputy Undersecretary for Monetary Affairs, playing a crucial role in shaping U.S. monetary policy during a transformative period in global economics. Volcker returned to Chase Manhattan Bank in 1965 as Vice President and Director of Planning, but his commitment to public service drew him back to the Treasury in 1969. Appointed Undersecretary for International Monetary Affairs, he was instrumental in President Richard Nixon's decision to suspend the dollar's convertibility into gold on August 15, 1971. This pivotal move led to the collapse of the Bretton Woods system, marking a significant shift in international monetary policy. Volcker later reflected on this event as the most important of his career, highlighting its profound impact on the global financial landscape. After leaving the Treasury in 1974, Volcker spent a year as a senior fellow at Princeton's Woodrow Wilson School, engaging in research and reflection. In 1975, he became president of the Federal Reserve Bank of New York, a position he held until 1979. During this time, he navigated complex economic challenges, including inflation and currency instability, further establishing his reputation as a skilled economist and leader. Throughout his early career, Volcker was known for his analytical rigor, commitment to public service, and willingness to tackle complex economic issues. His experiences in both the public and private sectors provided him with a comprehensive understanding of monetary policy, banking, and international finance. These formative years laid the groundwork for his later role as chairman of the Federal Reserve, where he would confront some of the most significant economic challenges in U.S. history. Volcker's journey from a small-town upbringing to the heights of economic policymaking exemplifies a dedication to understanding and addressing the intricate workings of the economy. His early life and career were marked by a series of deliberate choices and experiences that equipped him with the knowledge and skills necessary to lead the nation through turbulent economic times. His legacy serves as a testament to the impact that thoughtful and courageous leadership can have on a country's financial stability and prosperity. If you love finance, history, and game-changing decisions, smash that like button and share to fellow economic enthusiasts. Let's keep this conversation going. By the 1970s, America's economy was in deep trouble. Inflation was soaring, unemployment was rising, and the country's financial system was teetering on the brink of collapse. It was a time of economic uncertainty, with millions of Americans struggling to make ends meet. The situation was made worse by global events such as the oil crisis in 1973 and the breakdown of the Bretton Woods system, which had kept currencies tied to the US dollar. At the heart of this chaos was a crisis of confidence in the US dollar itself. People were starting to lose faith in the economy. For years, inflation had been steadily rising. Prices of everyday goods were climbing at an alarming rate, making it difficult for people to afford basic necessities. By 1979, inflation had reached a staggering 13.3%, the highest level the country had seen in nearly 4 decades. The Federal Reserve, which is responsible for controlling inflation, had struggled to deal with the problem. It had raised interest rates in an attempt to curb inflation, but these measures weren't working as expected. The economy was stuck in a vicious cycle of rising prices and stagnant growth, and the government seemed unable to break free from it. Unemployment was also a major issue. The jobless rate hovered around 6%, but it was the rising cost of living that really affected Americans. With prices soaring, families were finding it harder to make ends meet, and many were dipping into their savings just to survive. The situation was particularly difficult for the working class, who were hit hardest by inflation and wage stagnation. The government's failure to control inflation meant that the cost of living continued to climb, while wages remained relatively stagnant. Adding fuel to the fire, the 1973 oil embargo, triggered by the Organization of Petroleum Exporting Countries, OPEC, caused the price of oil to skyrocket. This oil crisis led to severe energy shortages, long lines at gas stations, and even higher inflation. It was clear that the U.S. was facing a perfect storm of economic challenges, and something had to be done. But the question was, who would step up to the challenge? In the midst of this economic turmoil, Paul Volcker was appointed as chairman of the Federal Reserve in 1979. At the time, the Federal Reserve was widely seen as ineffective in dealing with inflation, and the country was desperate for a solution. Volcker, who had spent decades working in the government and financial sectors, was not only highly experienced, but also known for his strong convictions and willingness to make tough decisions. He was not afraid to tackle the problems head-on, no matter how difficult the path might be. One of Volcker's first challenges was to convince both the public and the political establishment that drastic action was necessary. Inflation had become so entrenched in the economy that many Americans had come to accept it as a normal part of life. The idea of raising interest rates to control inflation was seen as politically risky, as it could lead to even higher unemployment in the short term. But Volcker understood that this was the only way to restore stability to the economy in the long run. He knew that the country needed to confront the problem head-on, even if it meant enduring some short-term pain. One of his first and most controversial moves was to implement what would come to be known as the Volcker Shock. This bold action involved aggressively raising interest rates to unprecedented levels in an attempt to break the back of inflation. At the time, inflation was out of control, reaching 13.3% in 1979, and Volcker understood that the only way to reduce inflation was to restrict the supply of money in the economy. To do this, he needed to make borrowing more expensive, which meant raising interest rates. The decision was not an easy one. Volcker knew that raising interest rates would have serious consequences for the economy in the short term. It would make borrowing more expensive for businesses and individuals, slow down economic growth, and potentially lead to a deep recession. But Volcker was resolute. He believed that the long-term benefits of controlling inflation were worth the temporary pain. If he didn't take drastic action, inflation would continue to spiral out of control, and the economy could collapse. In the months following the implementation of the Volcker Shock, the immediate consequences were harsh. Interest rates soared, with the federal funds rate reaching an eye-popping 20% in 1981. This meant that borrowing money became incredibly expensive, and people stopped taking out loans for big purchases like homes and cars. Businesses also cut back on investment, as the high cost of borrowing made it harder for them to finance expansion. As a result, the economy plunged into a severe recession and unemployment rates shot up. By 1982, the unemployment rate had reached 10.8%, the highest it had been in over 40 years. The effects of the Volcker Shock were felt across the country. Many industries, particularly those that relied heavily on credit, were hit hard by the high interest rates. The housing market suffered as mortgage rates skyrocketed, and construction projects were delayed or canceled. Small businesses struggled to stay afloat, and workers in industries like manufacturing and retail found themselves without jobs. The pain was widespread, and many people blamed Volcker for the tough times. But Volcker was unwavering in his commitment to reducing inflation, and he knew that the road to recovery would be long and difficult. Despite the immediate economic pain, Volcker's actions began to have an effect. As the months went by, inflation started to come down. By the mid-1980s, inflation had dropped to more manageable levels, and the economy slowly began to recover. Interest rates, which had reached as high as 20%, started to come down as well. The high rates that had initially caused so much pain were now being lowered as inflation eased. The economy began to stabilize, and businesses started investing again. The dollar strengthened, and the financial system regained its credibility. In many ways, Volcker's bold decision to raise interest rates had set the stage for the economic recovery of the 1980s. Although the short-term consequences were severe, the long-term effects were positive. By reducing inflation, Volcker had restored confidence in the U.S. economy and laid the groundwork for a period of sustained growth that would last for decades. The Volcker Shock, while painful, ultimately proved to be one of the most effective economic policies in modern history. The Volcker Shock also had important global implications. As the U.S. economy began to stabilize, other countries took notice. The high interest rates set by the Federal Reserve attracted foreign investors, which helped strengthen the U.S. dollar and make U.S. assets more attractive. This led to an influx of capital into the country, further boosting the economy. At the same time, the global economy was also feeling the effects of high interest rates, as other nations followed suit in an attempt to control inflation. The Volcker Shock had a ripple effect around the world, influencing the policies of central banks in other countries and shaping the global financial system for years to come. While the Volcker Shock is often remembered for its harsh short-term consequences, it was ultimately a necessary step in the battle against inflation. Volcker's willingness to take bold and decisive action, even in the face of significant opposition, saved the U.S. economy from a future of unchecked inflation and economic instability. The recovery that followed the shock was a testament to his leadership and his commitment to long-term stability. In many ways, Volcker's actions in the early 1980s marked a turning point in U.S. economic policy. His decision to raise interest rates and tackle inflation head-on signaled a shift away from the Keynesian economic policies that had dominated the previous decades. Instead of focusing on short-term growth, Volcker prioritized long-term stability, and his policies paved the way for a new era of economic thinking. The Volcker Shock became a symbol of the tough choices that policymakers must sometimes make in order to protect the future of the economy. Paul Volcker's legacy as chairman of the Federal Reserve is defined by his willingness to make the hard choices that others were unwilling to make. His actions during the Volcker Shock, while controversial at the time, proved to be the turning point that saved the U.S. economy from a future of rampant inflation. The pain of the early 1980s was real, but it was the price that had to be paid for long-term stability. Volcker's bold leadership not only shaped the course of U.S. economic policy, but also had a lasting impact on the global financial system. Paul Volcker's tenure as chairman of the Federal Reserve was defined by his commitment to battling the ever-present threat of inflation that had plagued the U.S. economy throughout the 1970s. By the time he took office in 1979, the country was caught in a vicious cycle of rising prices and economic instability. Inflation had surged into double digits, and the U.S. government's inability to rein it in had left many Americans frustrated and worried about the future. But Volcker, with his quiet determination and unwavering resolve, took on this monumental challenge head-on. His strategy not only reshaped the economy, but laid the foundation for a period of stability and growth that would last for decades. This unchecked inflation caused widespread economic pain. People's wages didn't keep up with rising prices, which made it harder for them to buy the things they needed. This environment of rising prices, coupled with economic stagnation, was coined as stagflation, and it left the economy in a state of uncertainty. The U.S. government's traditional approach to managing inflation, which relied on increasing government spending and lowering interest rates, had failed. In fact, these policies had made the situation worse. By 1979, the Federal Reserve's monetary policies were viewed as ineffective, and confidence in the U.S. financial system was at an all-time low. The economy was in desperate need of a leader who could take bold and decisive action to turn things around. This was when Paul Volcker entered the picture. When Volcker became chairman of the Federal Reserve in August 1979, he was fully aware of the severity of the situation. The challenge he faced was daunting. To rein in inflation, he knew that he would have to make unpopular decisions that would likely cause pain in the short run, but that would ultimately pave the way for long-term stability. Volcker's approach to tackling inflation was rooted in a deep understanding of monetary policy and the workings of the financial system. Unlike many of his predecessors, Volcker was not afraid to take the necessary steps, even if they went against conventional economic wisdom at the time. As the months went by, Volcker's policies began to show results. Slowly but surely, inflation started to come down. By the early 1980s, inflation had fallen from the double digits to a more manageable level, and the U.S. economy began to stabilize. The pain of the recession was still felt, but the long-term benefits were becoming apparent. The value of the U.S. dollar strengthened, and businesses regained their confidence. In the mid-1980s, economic growth resumed, and the economy entered a period of sustained expansion that would last for more than 2 decades. Volcker's decision to prioritize inflation control over short-term growth was controversial at the time, but it ultimately proved to be the right one. His policies laid the groundwork for the economic prosperity of the 1980s and 1990s. By taming inflation, Volcker had restored faith in the U.S. financial system, and his actions contributed to the stability that allowed the economy to grow for years to come. But Volcker's impact went beyond just controlling inflation. His actions also reshaped the way that the U.S. government approached economic policy. Prior to Volcker's tenure, the Federal Reserve had largely relied on government spending and tax cuts to stimulate the economy. However, Volcker's aggressive approach to controlling inflation marked a shift away from these Keynesian policies. His success in managing inflation helped to popularize the idea that a central bank's primary role was to maintain price stability, rather than to focus solely on promoting economic growth. Volcker's approach to monetary policy also influenced global economic thinking. The success of his policies in taming inflation led to a broader shift in the way central banks around the world operated. Many countries, particularly those in Europe and Latin America, adopted similar strategies of tight monetary control to curb inflation. Volcker's influence extended far beyond the borders of the United States, as his policies became a model for other central banks to follow. Perhaps most importantly, Volcker's actions demonstrated that bold leadership was sometimes required in times of economic crisis. His willingness to take tough and unpopular actions, even in the face of opposition, set a precedent for future policymakers. Volcker showed that the long-term health of the economy could not be sacrificed for short-term political gain. He proved that strong, decisive leadership could steer the economy through difficult times and set the stage for future prosperity. By taming inflation, Volcker didn't just solve the problems of his time, he reshaped the entire U.S. economy for the future. His legacy continues to influence economic policy to this day. Paul Volcker's impact on the world didn't end when he stepped down as chairman of the Federal Reserve in 1987. While he's remembered for his monumental work in taming inflation and stabilizing the U.S. economy, his influence extended far beyond his time at the Fed. Volcker spent the years after leaving office contributing to various causes, providing guidance to policymakers, and continuing to shape the financial world. But his legacy is not just about the policies he implemented or the decisions he made. It's about the principles he stood for: integrity, independence, and a commitment to long-term stability over short-term gains. After his departure from the Federal Reserve, Volcker did not retire quietly. Instead, he remained an influential voice in economic and financial matters. One of his most significant roles came when he was appointed to chair the Group of 30, a private international financial organization dedicated to fostering global cooperation in economic matters. In this role, Volcker provided valuable insights into the workings of international finance, offering advice to both governments and private institutions on how to manage financial risks and promote global economic stability. In the years following his time at the Fed, Volcker also became a respected figure in academia. He served as a professor at Princeton University and was an advocate for financial literacy. Volcker believed that a better understanding of finance and economics was crucial for the public, and he worked to ensure that future generations of policymakers and business leaders would be better equipped to handle the complex challenges of global finance. One of Volcker's most important contributions during this period was his involvement in crafting the Volcker Rule, a piece of financial reform legislation that sought to limit risky trading activities by large financial institutions. The rule, which was part of the Dodd-Frank Wall Street Reform and Consumer Protection Act of 2010, aimed to prevent banks from engaging in proprietary trading for their own profit, rather than on behalf of their clients. This was a direct response to the reckless behavior of banks leading up to the financial crisis. Volcker's goal was to reduce the risks that could potentially lead to another economic meltdown. His work on the Volcker Rule helped reshape the financial landscape and reinforced his belief that financial institutions should prioritize stability over short-term profits. Despite his influence in shaping economic policy, Volcker never sought the spotlight. He was known for his humble demeanor, his sharp intellect, and his unwavering commitment to doing what was right for the country. Unlike many other prominent figures in politics and business, Volcker was not driven by personal ambition. He was more concerned with ensuring that the financial system operated in a way that benefited society as a whole. This sense of duty and moral clarity is one of the reasons why Volcker's legacy remains so powerful today. In addition to his work on financial regulation, Volcker also made significant contributions to the development of public policy. He was a frequent advisor to U.S. presidents, providing counsel on a wide range of economic issues. Volcker served on several important government commissions and was instrumental in shaping economic policy during periods of crisis. For instance, in the early 1990s, Volcker was appointed by President Bill Clinton to chair a bipartisan commission tasked with addressing the country's growing budget deficit. The commission's recommendations helped pave the way for the budget surpluses of the late 1990s. Throughout his life, Volcker remained deeply committed to improving the lives of everyday people. He believed that the financial system should serve the broader public, not just the interests of the wealthy elite. He was particularly concerned about the growing income inequality in the United States and the concentration of wealth in the hands of a few. Volcker often spoke out against policies that he believed favored the rich and exacerbated economic inequality. He argued that a strong middle class was essential for the long-term health of the economy, and he advocated for policies that would ensure economic opportunities for all Americans, not just the privileged few. As the world changed in the 21st century, Volcker's voice continued to resonate. He was called upon to provide advice and guidance on a range of global issues, from the rise of emerging markets to the complexities of international trade. Even as he entered his later years, Volcker remained an active and engaged participant in global discussions about economic policy. His advice was sought by leaders around the world, and his influence extended far beyond the borders of the United States. Volcker's personal life was marked by a deep commitment to his family and his community. He was married to his wife Barbara for more than 50 years, and the couple had 2 daughters. Volcker was known for his humility and his ability to maintain a sense of perspective, even in the face of immense challenges. Despite his significant achievements, he never let fame or recognition overshadow his values. He was a man of principle, and his integrity was one of the defining characteristics of his career. In his later years, Volcker's health began to decline, but he remained active until the very end. He passed away in December 2019 at the age of 92. His death marked the end of an era, but his legacy lives on. Paul Volcker's influence on the finance world is undeniable, and his contributions to the financial system will continue to shape economic policy for generations to come. Paul Volcker's life and career serve as a powerful reminder of the importance of integrity, leadership, and long-term vision. His work to tame inflation and stabilize the U.S. economy in the 1980s is one of the most significant achievements in modern economic history. Want to understand the real power behind the economy? Hit subscribe and turn on notifications so never miss an update.